Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, welcome back to ETF Spotlight. I'm Daniel Snyder from Seeking Alpha. Today, we're jumping into conversation with Michael de Monte, but we're taking things interstellar. We are diving into an article he wrote just earlier a few months ago about ARKX. That is the Space Exploration and Innovation ETF. I have so many questions, but before we dive in, Michael, welcome to the show. You've been writing for Seeking Alpha for a little while here. Why space? Why, what made this ETF pop up on your radar?
Yeah, it's great to chat with you on the show. Looking forward to the conversation. And, space is such an interesting and unique concept for investing. You have this large pool of investments that's finally coming back to Earth, and no pun intended on that. But, there's just a lot of interest right now, whether it's for aerospace and defense or for the defense industry, or for just satellite communications and just like offshore oil. You have so much money being invested in space right now. It's just incredible time to be in the industry.
So we're going to dive into a couple of the catalysts that you have mentioned to me before, but you wrote this article back in August, and this ETF's up about 16.29% is what I'm seeing here on Seeking Alpha since you wrote that. So obviously been doing pretty well, even though we've been going through weird times in the macro environment. Obviously the administration stuff has that going on, tariffs, things are being removed all around the world for supply chains. It seems like in space also you have a lot of money that's in the private equity side of thing. And that's been a whole topic of conversation is, well, we can't always get access to what's going on. I know a lot of people think about Starlink or what Jeff Bezos is doing. And all these people are working on space, but we can't usually get access to that unless you're an accredited investor, right? So this ETF that ARK put together, we'd love to hear your rundown. I mean, what do you think about the expense ratio at 75 basis points? I mean, the assets under management are 522 million. You had mentioned stuff about this being high beta names within the portfolio. Can you give the investors listening today just a little bit of rundown?
Yeah, so just at a high level, 75 basis points, that's kind of a normal range for a more thematic type ETF. For an index fund, you might see something quite a bit lower, like through Charles Schwab or Vanguard is going to be 3 basis points. For something that's leveraged, you're going to look at 1.5 or 150 basis points. So for a thematic equity ETF, 75 isn't too terrible of an expense. As far as like the high beta theme, you're looking at companies that are in that high growth stage. Going back to the private equity side that you discussed, a lot of companies are pretty new, pretty innovative, and a lot of them are still pre-revenue. So they're building up all these expenses, building the technology, whether it's rocket ships, whether it's satellite communications, or whatever it may be related to space. They're in the development phase, they're in the testing phase, they're in the early stages of revenue or pre-revenue even. So it's, you don't have a lot to value these companies based on. You don't have earnings, you don't have free cash flow to look at. So you're kind of just basing your assumptions on what the potential growth is going to be for these companies. So it can result in quite a volatile market for one of them. You're gonna see a lot of momentum trading going on within the ETF, within the individual stocks. So it can lead to some pretty significant movements relative to the broader market.
So let's talk about some of the names, right? So Rocket Lab Corp, Kratos, Elfie Harris Technologies, Teradyne, Archer Aviation, Palantir, Advanced Micro Devices. I mean, there's more in here. That I think they're up to 33 holdings within this ETF right now. But as you were mentioning, some of them are looking for that next level of growth, right? So we've been having the tracking of Palantir and AMD. Like some of those make sense to me, but then you have like Archer Aviation, Rocket Lab. They seem a little bit more foreign. So where is the growth? Where's the revenue coming from for companies like that?
Yeah, so it's really interesting. I think the ETF, it has a pretty good balance between, I'll call it more traditional, but larger aerospace companies that might be more established. And then you have like the newcomers like Rocket Lab, and these guys. So it's kind of like I guess kind of like a balanced type approach to building the strategy. AMD, that's, I don't want to call it a no-brainer, but it kind of provides a little bit of a baseline, I'll say, for stability. The company's semiconductors, it can be put into satellites, it can be put into whatever you want. Excuse me, into the rockets, whatever. So there's some versatility in there. It's not like they're putting a GPU in the portfolio just because it's the cool thing right now. Palantir, there was a conversation to where the software would be utilized for the Golden Dome project, which is, that big uh, satellite project, the defense satellite system that kind of is designed to be a larger scale version of the Iron Dome in Israel. So it's essentially pulling in a ton of companies and their technology, whether it's laser systems, whether it's propulsion systems, whatever it may be, um, pulling in all these companies to integrate this large scale defense system to essentially defend against hypersonic missiles. So it seems like it's more broad than it is, but it all ties together at the end of the day.
So for Golden Dome, though, like what is, from what your research has presented you, what's the timeline on that? Are we talking that this is like a 1 year project that these companies are going to see hyper growth on their earnings and their balance sheets and everything else? Or is this like multi years, if not decades? Like we have a dream for a project. It might work, it might not. Of course, we know Iron Dome, but I mean, you go to space, you're talking about completely different physics up there.
Yeah, you have a bunch of satellites floating around and trying to
We have ones
communicate
that
with
crash
each
to
other.
Earth almost every week now as well, just because they're being decommissioned. Right. So it's like, what's the
Mhm.
timeline there? What should investors actually be thinking about? Like, is this going to be in the next few quarters? Or are we talking about year over year?
Yeah, so honestly, that's hard to say. There's no definitive timeline that has been presented at this point, as far as I'm aware. But it's a $175 billion project last time I checked, at least to get it up and running and started. As far as the investing horizon goes, it's probably going to take quite a few years just to get the project plan mapped out, who's building what and integrating what into what. So, it's not like you have one company building the, let's say, detection satellites. It's going to be a group of companies building that one component of the satellite. And then you have like more of the defense satellites, ones that are being designed to be equipped with uh direct energy or lasers, to shoot down hypersonic missiles, which are missiles that I think they were illegal. They were illegal to be built some years ago, and then the U.S. found out China was developing them. So it was kind of an uh-oh moment where we need to develop this technology. We need to develop countermeasures, things like that. So it's one of those things where it's it needs to be defended against. So it's going to be quite a long time horizon as far as I'm aware. You're going to look at 5-10 years to really get things up and running. Probably going to be longer. You're probably going to have ongoing maintenance. How long does a satellite have in space before it needs to be decommissioned and replaced? Like, what was it, like 10 years or so? It's not that long of a lifetime, when you consider the holistic part of it. So going to be something that, you're going to have your large scale investment up front over the next couple of years. You're probably going to have kind of like that testing phase revenue where, you get a grant for testing out that technology. You're going to get to the next round of grants to integrate it. It's just an ongoing process for space and defense projects like that. So we're probably looking at quite a few years before big money really sets in.
Okay. And then you had also mentioned to me before Artemis program and artificial intelligence and that how those might support this ETF specifically. What's the cases there?
Yeah, so Artemis is quite an interesting project where NASA is essentially looking to land and build a development on the moon, or I think it's on the the South Pole or the dark side of the moon. Not to quote Pink Floyd there, but they're looking to build an establishment, an autonomous site on the moon to essentially act as a midpoint, so to speak, to get to deeper space. So when you launch a rocket to get to space, it uses up quite a bit of fuel and resources just to get out of the Earth's atmosphere. So building that, I guess, moon base is going to be kind of like that refueling station. You're taking your spaceship to the gas station to be able to get further out without having to deal with another layer of intense gravity that's pulling you out. So it's kind of an interesting project. I believe it's had a few delays here and there. Intuitive Machine was one of the companies that was a part of it. They made big headlines the other year with their lander or rover not landing upright and then essentially running out of energy after some time. So it's an interesting project, a little complex from what it looks like, but it's something that is moving along. What was the other question?
Also, we talked about artificial intelligence would also probably benefit this ETF because of the names like A and B, right? For example. So wanted to ask you before we wrapped up here, on your article back in August, you said, I reiterate my buy rating, but advise reducing ARKX exposure as a percentage of a portfolio to manage risk and maintain diversification. And that was north of 16% ago, or your 16% return you've had since then. The ETF price from when we're recording this is hovering near $31 a share. I got to ask you now that it's been a few months, are you still a buy? Are you still reducing exposure? There's been a lot of changes in the macro environment. What are your thoughts now? Where do you stand with the rating on this ETF?
Oh yeah, absolutely. So it still stands at a buy. Circling back to our conversation earlier about high beta names, you have the Federal Reserve that's actively they're expected. I don't want to say they're actively because they can change their minds at any time, but they're expected to reduce the interest rate by 2 incremental cuts throughout the rest of the year. So 2 25 basis point cuts throughout the rest of the year. And then it seems like they're going to be cutting one more time in 2026, depending on the macro data, which isn't currently coming out with the government shutdown. Aside from CPI this last week, we could see more cuts. We could see a lot of things change between now and next year. So, in correlation with high beta stocks, they typically do exceptionally well during interest rate cuts. You have lower cost of financing. You need that alternative to receive yield. So you can expect, or you can typically expect high beta stocks to do pretty well during periods of lower cost of capital.
All right. So you're saying risk on. All right. Thank you so much, baby. Michael. Everyone, thank you for watching this episode. If you haven't already, go follow Michael on Seeking Alpha. Go to his author profile. He has hundreds and hundreds of different pieces of analysis that he's published. He's publishing new ones all the time, long-term focus and stuff like this. This is so unique ETF. I love it because not a lot of people focus on the space side of things. For some people, I know it just feels like a dream that's a little bit too far or not there yet, but that's what makes it exciting to me. So, Michael, thank you for taking the time to speak with me today. Everyone, this has been another episode of ETF Spotlight. I'm Daniel Snyder, and we'll see you next week.